I'm Deborah Borchardt, and this is your midday market update. Well, we saw a little bit of a lift in the Dow when we got those employment numbers earlier, but it seems like we've lost that momentum. We went flat. We're just about flat now in the S&P 500 and the NASDAQ, both down right now. Of course, what we're also seeing is poor performance out of Twitter in response to the earnings. Joining me now is Mark Newton. He is the chief technician over at Greywolf. So Mark, we have been seeing these momentum names lose a lot of the gains that they had, and Twitter is one of them. They've lost a third of their value already year to date, lost another 11% today. The market seems like it's just not willing to take a risk now on these internet names.
Yeah, they certainly have been a real problem for the market, somewhat of a headwind of late. Not only the small caps, but the internet names. I think a lot of them are getting down to levels that actually make sense to step in and buy. I took a look at the FDN, which is the ETF for a lot of the internet names, and it's getting down to levels that at least technically would seem to make sense. It's a tricky market. The last few weeks we've seen a decent pop in stocks. The Dow's about to hit new high territory again, but yet the breadth and the momentum has been really lacking, and people have been talking about that for some time. You do have some end of the month, to some extent, bullish seasonality, but yet the internet names, along with the small caps, have been problematic for stocks. You still have some geopolitical tension. So it's going to be tricky going forward. The uptrends are certainly very much intact, but the markets have been really unchanged for the last 2 months now.
Well, you're right. There's certain conflicting things happening here with this market because as you mentioned, the Dow at near high levels, and yet the feeling is that we certainly aren't at those levels. We feel that because we've got utilities outperforming, that we're in a defensive mode, and yet the market's not performing as if it's defensive.
Yeah, you've seen the market take on a more defensive posture really in the last few weeks. Consumer staples and utilities have both moved to new monthly highs in relative terms to the S&P. That's interesting. One thing I might mention is that if you look at the percentage of stocks above their 50-day moving average, you're almost half of levels that you were in early April and almost in December of last year when the market made its peak. So that's interesting. We had almost 85% of stocks above their 50-day as of early April, and you look back, and now we're, I think, in the low 50s, almost dripping down to the 40s. So you have far fewer stocks participating. That is a worry, but yet we continue to see the sector rotation move in and bail out the market. Once again, we see industrials, which are very strong. Energy has started to make strides. That's a positive.
But we're not crashing through that support, that resistance level. We're not crashing through. So that gives, to me, a sign that when we hit May, we may sell in May and go away.
Well, we're muddling along, but there are a couple things that are important in my work. One is that you're starting to see signs of financials and technology try to bottom out. And relatively speaking, if you start to see a bounce in these sectors, they've both been under pressure for the last month and a half. That would be a positive because that represents about a third of the market. So, look, the broader trends are intact. You've got a lot of people that are expecting a correction for a lot of good reasons, but when you see prominent investors come out of the closet, so to speak, and say the market's going to pull back, we're in a bubble, it's very rare that they're right at the top and pinpointing pullbacks, whether it be Doug Cass or Einhorn or everybody in mass, and people have been expecting this for some time. So, you just have to stick with the trends. You have to stick with the sector rotation. Right now, it is right to be still positive in utilities and staples, but you have to be in industrials, energy, and I would look for bottoms in tech and financials. One thing to watch, the final note, watch the 10-year Treasury yield and also watch dollar yen. Really in the last few days, the market's really been keying off those. It continues to see very high correlation with both. So regardless of the GDP number this morning, the market didn't do anything. Dollar yen started to tank. The S&P followed suit. So 260 is a big level. Dollar yen, I think the level right near 121. It's going to be important.
Okay, so there you go. Mark's telling you what to watch. He's telling you watch that dollar yen and watch that 10-year. Also, keep in mind, some of those defensive sectors look to be the best place. That's Mark Newton from Greywolf, and I'm Deborah Borchardt with The Street.